Hey everybody, Derek Christensen here. I'm the owner of Legion Law, a premier estate planning and probate firm in Dallas, Texas. Today, I wanted to talk about ILITs. What are they? How do they accomplish things? And what do you got to do to make sure you maintain them the right way? But before I do that, I wanted to let you know how to reach out to me. You can email me directly, Derek, D-E-R-E-K, at legionlawpllc.com, or you can find me on my website, www.legionlawpllc.com. So with that, let's dive into this interesting topic. And I say that because life insurance, I'm not a fan of life insurance, or I'm not a fan of insurance just because I've had many negative interactions with them. But this is actually pretty dang important for a lot of people who have a lot of money. So what is an ILIT? An ILIT is an irrevocable life insurance trust. Now what does that mean? It means that you're going to create a trust, and this trust is going to own an insurance policy. A trust, if you didn't know, is a legal entity that can actually act kind of similar to a company. You can own things, it can have rules, it can have people in charge, it can have very specific conditions that you set up. So it's nice because a trust can own assets just like a normal individual. And in this circumstance, what you're going to do is you're going to have your trust, you're going to put somebody in charge. That person in charge is going to get a life insurance policy. They're going to put that policy on you. And when you pass away, that money is going to go into that trust, and the trust is going to disperse those funds according to the terms of the trust. So this sounds like a lot of work just to do what exactly? And the answer is to avoid the estate tax, or to pay less of the estate tax. I don't encourage you to avoid taxes, but if you legally can reduce your tax bill, you absolutely should. And this is one of those strategies. The estate tax, for those who don't know, is set by an exemption amount. So the government, the Congress will set a limit, and they'll say by this number of dollars, anything above it, we're going to tax about 40% of it. So if your estate is worth $12 million and the exemption amount is 10, then you're going to owe 40% of $2 million, which is $800,000. And that's $800,000 that are not going to your children. So it's going straight to Uncle Sam, and I don't think most people want that. So in this circumstance, right now, at least from this videotaping, the exemption amount is $12 million for individuals, $24 for couples. However, in 2026, that's going to get halved to about $6 and $12 million if the Trump tax cuts don't get extended. So in this circumstance, what you would do is you'd say, oh crap, I think I'm above the limit. Oh my goodness, what am I going to do? So you go talk to an attorney like myself, you set up the trust, and what you're going to do is you're going to gift the amount that you can to each of your beneficiaries that you want, right up to the exemption amount. So this is going to require a little bit more information about gift taxing as well, because just like the estate tax, there's the or estate exemption, there's the gift tax exemption. So I can't just give you $1 million and not pay anything. Technically speaking, I'm supposed to give you $1 million, report it to the government, and then I get either taxed by the gift tax or I lower my exemption amount on the estate tax. That's a different video time. But what I'm trying to say is there is a gift tax to worry about, because if I give you too much money, the government wants me to pay up. So the exemption amount for gifting is $17,000 for an individual and $34,000 for a couple. In other words, my wife and I, we can give $34,000 to my brother without having to report it, without having to pay any taxes, all as well. However, if I go above that, then I owe 20 to 40% of any dollar above that $34,000 threshold. So the strategy is this is what you do. Instead of gifting that $34,000 to your kids, what you're going to do is you're just going to take those $34,000, you're going to put it inside the trust, and then the ILIT, inside the ILIT, and then you'll use that $34,000 per year to pay for the life insurance premiums that are going to pop up. So by using those gifts to pay for the life insurance premium, you're lowering your estate amount, trying to get below that exemption amount, and you're going to have those premiums being paying for a life insurance policy, which then will later on pay your estate tax bill or go directly to your kids if you don't have an estate tax bill. So ILITs are pretty neat in that fact. There are some cons to it. You do have to maintain them. They are irrevocable, and they require you to give up control. So more specifically, maintaining them. What does that mean? So in the IRS, they say a gift is a gift if they can receive it immediately and unconditionally. Now, immediately means it's right now, and unconditionally means you can't say, hey, I'm going to give you $5,000, but if you spend it on sweaters, then you got to give it back to me. That's not a gift. It's a conditional grant of money. So in this circumstance, what you're going to have to do is send what's called a crummy letter to your children, because the gifts that you're giving, instead of to your children directly, that $34,000, you're not giving it to your children directly, you're actually giving it to your trust. So it's not to your children. That money is going to get spent for years and years, and then it'll finally come up. So it's not immediate, and your children can't control that money because it's inside the trust rather than their own bank account. Therefore, it's not really a gift. So the IRS lets you actually send a letter to your kids and you say, hey, I'm putting this money inside the trust. Please don't touch it for 30 to 60 days. And if you don't, then it's going to be considered a gift and I'm going to get away with this, and the insurance policy is going to pay you out way later on. And if the kids don't touch that money, then you're good. That money goes into the trust. You're fine. And if they touch that money, you can't stop them. They can actually just take that money, take it as a check, and they can go live their merry lives. But it's kind of a wink, wink, nudge, nudge situation where you tell your kids don't do that. And if they don't, then again, the policy will pay out, it'll pay the taxes, and you're good to go. So that's the maintenance. You have to make sure those letters are done correctly every single time you transfer money into the trust. Additionally, it's irrevocable, which means you're not in control, someone else is. And that bothers people understandably. But this is a strong strategy to lower your estate taxes. So either way, that's kind of how ILITs work. There's a lot more I could talk about, whether it's the crummy letters or what they look like specifically and stuff like that. But that's the 10,000 foot view. If you have any questions on that front, feel free to email me directly, Derek, D-E-R-E-K, at legionlawpllc.com, or find me on my website to schedule a free consultation over the phone directly onto my calendar on the Contact Us page of www.legionlawpllc.com. So with that, thanks for watching and have a great day.